Good morning. Good morning, and thank you, Roseanne. Welcome, everyone. PNC is delighted to be providing our speaker today. PNC is one of the largest and most diversified financial services industries with over 500 billion in assets. Gus is our chief economist. As you may have read, he is frequently cited in international, national, and regional media outlets, including the Wall Street Journal, the New York Times, ABC World News, and is also featured on Nightly News, NBC Business Report, Fox Business, as well on the radio, CBS Radio and NPR. Gus serves on the board of directors for the Economic Club of Pittsburgh, and he earned his PhD in economics from the University of Pennsylvania. With that, let me turn it over to Gus.
Okay, lights pulled up here, just 1 second. Thank you all very much, and I appreciate your flexibility in arranging this virtual session with us today. And sorry, I just need to do this. There we go. All right. Is that good? My slide's showing up okay there? All right, thank you. So we experienced a recession in March and April of actually 2 years ago now, I guess at this point, of 2020, that was very different from other recessions in the United States. So the recession that we had in the spring of 2020 was caused by something external to the economy, the coronavirus pandemic. If I had been talking with you 2 years ago in January of 2020, I would have said that the current economic expansion has lasted for 10.5 years, but the economy is still in good shape, and we would have expected the economy to continue to expand throughout 2020. The underlying economic fundamentals were good. We were at that point starting to follow what was going on in China with this new emerging virus, but there was nothing within the economy that indicated problems. And so the recession that we experienced 2 years ago came on very suddenly, and it was caused by something external to the economy. If we think about the Great Recession and the financial crisis from 2007 to 2009, that was caused by problems in the housing market that spread to the financial system. If we think about the recession in the early 2000s, that was caused by the bursting of the tech bubble. The double dip recessions we had in the early 1980s, 2 recessions in quick succession, one of which was quite severe, that was caused by very high inflation, the Federal Reserve aggressively raising interest rates to slow inflation. This time around, everything looked good, and except we got hit by this very large external shock to the economy. We saw a very swift policy response from the Federal Reserve in response to the pandemic. So you can see that the yield on a 3-month Treasury bill, when it costs the federal government to borrow for 3 years, that fell very quickly from around 1.5% in early 2020 to close to zero a couple of months later. That was as the Federal Reserve cut what's called the, excuse me, the Fed funds rate, their key short-term policy rate. They cut that in early 2020 as the pandemic started to hit the economy. And then the Fed said, we need to do more to support economic growth. So the Fed started to buy long-term treasuries, mortgage-backed securities. That helped push down long-term interest rates. You can see that the yield on the 3-month Treasury, the 10-year Treasury bond, excuse me, what it costs the federal government to borrow for 10 years, that fell from close to 2% in early 2020 to below 1% last year. As the Fed was trying to push down long-term interest rates as well to support long-term borrowing. Now, you can see that we have seen longer-term interest rates increase. I was looking this morning. The yield on the 10-year Treasury is up now to about 1.8%, so that's as high as it's been since before the pandemic, but still long-term rates remain very low on a historical basis, and that is supporting consumer borrowing, borrowing for new homes, business investment, and all of that is supporting the economic recovery that is underway in the U.S. economy. And we've seen the stock market bounce back very quickly. So the blue bars, that's the S&P 500. That's a broad measure of stock prices in the United States. On the left-hand axis, you can see that that fell by about 1/3 between early 2020, and then the worst of the downturn in April of last year. But since then, stocks have come roaring back, and it seems like every day, every other day, we see a new record high in the stock market. We've had a little bit of stocks are down a little bit in 2022 because of higher interest rates, but still much, much higher than they were before the pandemic. The stock market is forward-looking. It is looking at conditions not as of January 18th, 2022, but where investors think the economy will be, in particular, where investors think corporate profits will be 6 months, a year, or 2 years down the road. I think it's fair to say that the stock market right now is pricing in continued expansion in the US economy, and in particular, continued improvement in corporate profits in the US economy. Similarly, if we look at the VIX index, the orange line on the right-hand scale, that's a measure of how much stock prices are moving up and down. You can see that enormous spike in volatility in early 2020 as the pandemic came to the United States, gradually receded over 2020, 2021, up a little bit more recently because of concerns about the Omicron variant and so forth, but still much lower stock price volatility than what we had during the worst of the pandemic, although certainly more stock price volatility than what we saw in 2017, 2018, 2019. We had an enormous disruption in the labor market from the pandemic. We lost 22 million jobs in just 2 months, March and April of last year. To put that in context, during the Great Recession, which was a very severe economic downturn, the economy lost about 8 million jobs over 2 years. So this was a much larger contraction in the labor market in a much, much shorter period of time. Now, the good news is that we've added back, about 19 million of those jobs. The bad news is, of course, that means we're still down by about 3 million jobs from where we were before the pandemic. So very steep contraction in the labor market, very swift recovery, but we still have a long ways to go before we see jobs reach their pre-pandemic levels. So, it's still a mixed picture on the labor market. And in particular, we have had a lot of people drop out of the labor force. So this chart shows what we call the labor force participation rate. This is the share of adults who are either working or looking for work. Now you can see that, first of all, there's been a long-term decline over the past 20 years because of the aging of the baby boomers. And so they've been approaching retirement age and been dropping out of the labor force, but it had stabilized prior to the pandemic. And then you can see that with the pandemic that we went from about 63% of adults working to or looking for work down to about 60%. So huge dislocations there. Now, we have seen some of those people come back into the labor market, but not all of them. We still are down by about 2.5 million people in the labor force compared to where we were before the pandemic. Where have these people gone? Well, some of them took early retirement. Perhaps they were in their 60s and were planning on working for a few more years, but once the pandemic hit, they decided just to retire. Some of it is parents of young children who are dealing with closed childcare centers, with virtual schooling, and so they've been unable to work or look for work. Some of it is because of people who are concerned about the coronavirus. Perhaps they have compromised immune systems, perhaps they have family members, but they're reluctant to go back out into the workforce, particularly if it's dealing with people on a day-to-day basis, and so they've dropped out. And then perhaps some people, because of government assistance, increased unemployment insurance benefits, stimulus payments that many households receive, they're being pickier in choosing a job. Now, those extra unemployment insurance benefits expired in September. So you can see that in particular, we have seen some people come back into the labor force over the past couple of months, but we're still down by about 2.5 million people from where we were before the pandemic. And that's why businesses are reporting difficulty in hiring, because there are just a lot fewer people now either working or looking for work than there were before the pandemic. So here I'm going to stop and take one of the polling questions. So the first question is, Compared to before the pandemic, how is demand for your business? There's choices are no recovery in demand, partial recovery, full recovery, or demand is above its pre-pandemic level. Great. So you have about 30 seconds to answer that question.
I'm going to end that poll, folks, so get your answers in. And there are your results.
Okay, so you can see that no one has said that there's no recovery. 40% of respondents have said there's a partial recovery, 36% said a full recovery, and for a quarter of you, demand is above its pre-pandemic level. And that is consistent with the economic data that we have been seeing. This shows three measures of the size of the economy. The most prevalent is GDP, output of goods and services. That's the broadest measure of economic activity that we have in the United States. All of these measures are adjusted for inflation. And I set the peak before the pandemic equal to 100. So the other two are what we call final sales of domestic product. The green line, that measures that's GDP minus the change in inventories. It measures demand for goods and services in the U.S. economy, whether that demand comes from the U.S. or from abroad. The orange line is an alternative measure of the size of the economy. That's gross domestic income. That looks at the income going to households and businesses from economic activity, so it excludes government transfer payments. You can see that by all of those measures, we had a very severe contraction in the US economy in early 2020. Basically, between the fourth quarter of 2019 before the pandemic and the second quarter of 2020, excuse me, second quarter of 2020, when things were at their worst, the economy contracted by about 10%. We were producing 10% fewer goods and services in the United States than we were before the pandemic. And then you can see that we have had a recovery. And in fact, GDP, gross domestic income, now they're actually above their pre-pandemic level. So economic output now is actually larger than it was before the pandemic, which is pretty impressive given that very steep decline that we saw. If you go back to the Great Recession, for example, you saw that GDP declined about 4% over 6 quarters. So a smaller contraction in the economy over a much more substantial period of time. But it took a few years for GDP to get back to its pre-pandemic level. And so, it has definitely been a very swift recovery in the US economy. That being said, the recovery has been uneven across sectors. So here the blue bars show the change in activity between the fourth quarter of 2019 before the pandemic and the second quarter of 2020 when things were at their worst. Again, these are adjusted for inflation. The orange bars are the change from the fourth quarter of 2019 to the third quarter of 2021, so the latest reading that we have. And you can see, for example, that consumer spending on services, that fell by about 15% initially in the first stage of the pandemic. And this is all kinds of services: education, healthcare, what we call personal care services, which is everything from childcare to haircuts and dry cleaning, financial services. Huge contraction in consumer spending on services. And as of the third quarter of last year, it was still down by a couple of percent from before the pandemic. So it had not fully recovered. On the other hand, look at consumer spending on goods, either durable goods, big ticket items like cars and appliances meant to last more than 3 years, or non-durable goods, food, clothing, medication, gasoline, meant to last fewer than 3 years. You can see that consumer spending on goods fell initially, but now is well above its pre-pandemic level. Look at consumer spending on durable goods, more than 20% above where it was before the pandemic. We are not buying as many services, but we are buying a lot more goods now. And that is why we're having such supply chain difficulties, because households are buying a lot more goods now than they did before the pandemic. And it's taking time for US manufacturers, foreign manufacturers, the transportation distribution system to catch up to this much stronger demand for goods than we experienced before the pandemic. Business fixed investment, that's investment in commercial construction, energy infrastructure, equipment, including information technology, software, R&D, those types of things. That fell by about 10% initially, now slightly above its pre-pandemic level. Residential investment, that's investment in housing. So that includes construction of single family and multifamily homes, apartments and condominiums. Also includes repairs and renovations to existing homes. You can see that that fell by about 5% initially, but it's now up 13, 14% above its pre-pandemic level. We're all working from home. We've gotten tired of seeing, the same old house. Maybe, you have family members who are working at home. So you've invested in a home office. Very low mortgage rates have helped there. That 30-year fixed mortgage rate was below 3% for much of the past couple of years. That supported household borrowing for investment in housing. And so that has been a big contributor to the economic recovery that is underway. Government and consumption and investment, that excludes those transfer payments that many households receive. So this is just government purchases of goods and services, actually not much change there. Exports fell by about 25% initially, still down now about 10% from 10% below its pre-pandemic level. Other economies have been slower to recover than in the United States. Imports, on the other hand, those fell by about 20% initially, now about 5% above their pre-pandemic level. And again, this helps explain those supply chain difficulties. A lot of the goods that households and businesses have been buying have been imported goods. And so that is why we have all these ships that are stacked up at the ports. That's why we're having shortages of some goods in the United States, because of very strong demand for imports. And then finally, this last one at the bottom, this is the key to the entire thing. After-tax personal income. This is income from all sources going to households. So it's income from investments, it's income from the job market, it's income from government transfer payments. You can see that that jumped more than 10% between the fourth quarter of 2019 and the second quarter of 2020. Now let's go back to what was going on. We lost 22 million jobs over that period, huge job losses. All of the income from those jobs was wiped out, and yet household income increased more than 10% because of stimulus payments to households, because we made more people eligible for unemployment insurance benefits, the self-employed, gig workers like Uber and Lyft drivers, independent contractors, and we increased the level of unemployment insurance benefit. And so that gave people more money to go out and buy a new car, buy an appliance, put a down payment on a home, pay for renovations to their home, all of that. Now, you can see that household income has declined since then. But even as of the third quarter, it was still about 5% above its pre-pandemic level, even though employment was still down by about more than 3 million from where it was before the pandemic. And so this aid from the government has made a huge difference, and that's what's allowed for this huge rebound that we've seen in consumer spending, particularly on goods. And the good news is that households will continue to spend throughout 2022 and into 2023, and that is going to support continued economic expansion. Consumer spending makes up about 2/3 of the US economy. The blue line on the left-hand scale, that is the personal saving rate. That is the share of after-tax income that households are saving. Few things to point out. First of all, even before the pandemic in 2019, household saving was much higher than it was heading into the Great Recession. So households already had a bigger cushion this time around than they did before the last recession. And then look at that huge jump up in the savings rate with the pandemic. What was going on? Well, households couldn't spend money, right? You couldn't go out to dinner. You couldn't go to the movies. You couldn't go on vacation. So you were cutting back on your spending. At the same time, your household income went up because of those stimulus payments. So households were saving a huge amount of cash. Households have saved up about $2 trillion extra relative to before the pandemic. Remember, I said consumer spending accounts for about 2/3 of GDP, which means that households have the ability to spend down their savings over the next couple of years to support household spending growth. And particularly as the economy continues to reopen, we're going to see household spending growth shift from goods to services. So growth in goods, we've already bought a lot of goods, a lot of appliances, a lot of cars, that type of thing. So we're going to be spending relatively more on services, relatively less on goods over the next couple of years, hopefully as the pandemic fades. Similarly, if we look at the orange line on the right-hand scale, that's the financial obligations ratio. That's the share of after-tax income that households are spending on mortgage payments, rent for renters, homeowners insurance, property taxes, student loans and leases, credit card payments, all of those types of things, extremely low right now, near a record low. Part of that is government aid. Part of it is debt relief from the federal government on student loans and so forth. Part of it is that households use stimulus payments to pay off high interest rate debt, or they refinance their mortgages. But that means as the economy continues to improve, as the job market continues to improve, that households will be able to borrow to fund purchases of big ticket items, and that will support economic growth in 2022, 2023. Another factor that's going to support growth over the next couple of years is the need to rebuild inventories. Many businesses are short of inputs. They can't get all of the inputs they need. As soon as they produce something, it's sold. And so inventory levels relative to the size of the overall economy are extremely low right now, which means that as supply chain disruptions gradually fade, as manufacturers are able to increase output, businesses will need to increase inventories, and that will be a big support to economic growth over the next couple of years. So our next question is what is the biggest problem for your business right now? Weak demand, inability to obtain inputs, high labor costs, higher non-labor costs, or an inability to attract or retain labor?
Okay, folks, I'll give you just another second or two to answer that poll. All right. And there are your results.
Oh, wow. Okay. 2/3 of you said the biggest hurdle for businesses is the inability to attract or retain labor. And then I would just point out that another 20% said it was higher labor costs. So that's 84% cite labor is the biggest problem in the economy right now. And I think, again, that goes back, to that big decline in the labor force participation rate that we were talking about earlier. Okay. PNC does a small business survey twice a year. This is our latest results from fall of 2021. And you can see that generally small businesses were feeling very optimistic about things. Now, this was before the Omicron variant, but still, we are still dealing with high inflation at that point, inability to hire, that type of thing. Even so, you can see that the share of small business owners that were pessimistic about their company's own prospects over the next 6 months was at a record low. So even with all of the difficulties that the economy is facing, small business owners are still feeling pretty optimistic. We'll have results for our spring 2021 survey in a couple of months. Businesses, we're watching what's going on with businesses. If you look at business debt, the blue line on the left-hand scale as a share of the size of the economy, that's actually near a record high. You can see that it soared with the pandemic as businesses drew down their lines of credit as they got Paycheck Protection Program loans from the federal government. It's since fallen then, but still well above its pre-pandemic level. But again, don't forget that interest rates are still extremely low right now. So if you look at interest payments as a share of cash flow for non-financial corporations, that's near a record low. And so although we are watching business debt levels, right now the level of business debt does not represent a threat to the economic expansion. I mentioned all of the aid that households have received from the federal, not just households, that the economy has received from the federal government, about $5 trillion. That's about 1/4 of U.S. GDP. That is larger than in most other developed economies, and that's a big reason why the U.S. recovery has been stronger than recoveries in other economies. About $1.2 trillion of that was aid to small businesses, primarily through the Paycheck Protection Program. That provided low interest loans to small and medium-sized businesses. Those loans will be forgiven if those businesses meet certain requirements in terms of keeping workers on their payrolls. I'm on the board of a small nonprofit here in Pittsburgh that provides transitional housing for veterans. We received 2 rounds of PPP funding, and have received forgiveness on one. We're in the process of receiving forgiveness on the other. But in our latest small business survey, we did a survey, and of those businesses that had received a PPP loan, 75% said it was extremely important to their business, and another 20% said it was somewhat important. So that has made a huge difference, has allowed many small and medium-sized businesses to stay open through the worst of the downturn and then recover, reopen, as the economy is improved. Those stimulus payments to households, about $800 billion. Aid to states, this has made a big difference. States have not needed to either increase taxes or cut spending, which would have weighed on the recovery. So aid from the federal government to states has made a big difference in the economic recovery. Extra unemployment insurance benefits, an extra $600 billion to households. Aid to big businesses, primarily the airlines. That's important for an area like the Twin Cities. Obviously, Delta is very important there, and so that's made a big difference in that industry and has allowed that industry to recover without too many layoffs, and then additional support for the economy. But it's all made a huge difference, and that's why the economy has rebounded so quickly. And then you're probably saying to yourself, well, can we afford this as a nation? My answer is that we could not have afforded not to do it. Remember those 22 million jobs that we lost in early 2020. Imagine if we had not supported households and all of those households had cut back on their spending, how much worse shape we would be in as a country right now. If we had not supported small businesses through the Paycheck Protection Program and we had all of those businesses fail. Now, it is true that we have taken on a lot of debt to pay for this. You can see that federal government debt held by the public, the orange line on the right-hand scale, that did soar with the pandemic, has started to decline more recently as the economy has begun to recover, as we've wrapped up some of those stimulus programs, but very high. On the other hand, don't forget that interest rates are very low right now, including interest rates for the federal government. So if you look at interest payments on the federal debt, the blue line on the left-hand scale, as a share of the size of the economy, that's really quite low right now. And so it was vitally important that the federal government step in and support economic growth at a time when the economy was literally in free fall. And so that has made a huge difference, and that's what's allowed the economic recovery that is underway to take place. Now, obviously, there's been a lot of concern, a lot of talk about inflation. We have seen higher inflation lately. The Federal Reserve is responding to that. So this shows federal government purchases of long-term securities. If you remember at the top, I said that when the crisis hit, the federal government started to buy long-term securities. So longer-term treasuries, the orange bars, Mortgage-backed securities, the blue bars, you can see those have ramped up in 2020, 2021. As the federal government has bought these securities in an effort to push down long-term borrowing costs, mortgage rates, costs for businesses to invest, costs for governments to fund their operations, including the federal government. With inflation higher than the Federal Reserve would like, the Fed is starting to reduce those asset purchases. And in fact, I would expect that the Fed will wrap up those asset purchases sometime in March. So the Federal Reserve's balance sheet will stop growing later this year as they wrap up those purchases of assets that are designed to put downward pressure on long-term interest rates. And that's why we have seen longer-term interest rates increase. That's why the yield on the 10-year Treasury is up to 1.8% as of this morning, because the Federal Reserve is providing less support to the economy. Obviously, inflation is higher than the Federal Reserve would like. It's up about, depending on what measure you use, 6 or 7% from a year ago. That being said, financial markets are not terribly concerned that inflation is going to get out of control over the longer term. This chart, this is not actual inflation. This is what we call five-year forward inflation expectations. So this is what financial markets think inflation will be 5 to 10 years from now. So early 2027, through early 2032. And this is based on the yields on regular Treasury securities. Plus there's something called TIPS, Treasury Inflation Protected Securities. Those are treasuries that pay a rate of return plus whatever inflation turns out to be. And you can use that to back out what financial markets think inflation will be 5 to 10 years from now. And the Federal Reserve has set an inflation objective of about 2%. They want inflation to average 2% over the longer run. And you can see that financial markets think that inflation is going to be just about 2%, maybe a little bit above 5 to 10 years from now. So certainly financial markets do not think that inflation is going to get out of hand. And there has, sorry, let me stop and ask our next polling question. So thinking, and let's think about this for all of 2022 compared to all of 2021. Where do you see your company's prices in 2022 relative to 2021? Do you think prices are going to be lower than they were in 2021? Do you think they're going to be up 0% to 2.5%? 2.5% to 5%, 5 to 10%, or greater than 10%?
Folks, this is the third poll out of 4. I'll give you just a few more seconds to answer the question, and then I'll share the results. And there are your results.
Okay, so businesses generally expect, about half of you expect to increase your prices about 5 to 10% this year. Some of you have smaller price increases, a few of you have larger price increases. And this is consistent with what we're seeing in the economy right now. Overall, prices for consumers are up, depending on what measure you use, somewhere between 5 and 7% from a year ago. So this is consistent with those results. Now, there are different measures of inflation in the economy. So let's look at these various measures and think about what they mean. So the blue line is what we call the producer price index for intermediate unprocessed goods. So these are raw materials that one business sells to another business. And you can see that we had a huge spike in these prices earlier in 2021. They were up about 60% year over year. So this is when we were hearing about lumber shortages and very high prices for lumber, for raw iron ore, for crude oil, that type of thing. Now, you can see that prices are still increasing, but at a slower pace in the second half of 2021. So we are seeing some slower inflation for these raw materials, still high. But I would point out that, yes, this is stronger inflation than we've seen over the past 10 years or so, but not completely out of hand with previous price trends. All right. Now let's look at the producer price index for processed goods for intermediate demand. These are goods that have been finished, but that businesses sell to other businesses, not to consumers. So this is things like steel, finished steel, computer chips, that type of thing. You can see that we are having higher inflation for those types of goods, but much slower than what we're seeing for unprocessed goods, and that we are starting to see some of those price increases level off in late 2021. And then finally, the blue line is what we call the core PCE, personal consumption expenditures price index. This excludes food and energy prices, which tend to bounce around a lot. And may not be indicative of underlying trends in the economy. And this includes a lot of what we buy as consumers, remember, are services. So we buy healthcare, we buy education, we buy financial services, all those types of things. And this includes services as well as goods. And you can see that, yes, we have had an acceleration in inflation. It is higher than that 2% that the Federal Reserve would like, but it's, we had inflation that was below 2% for much of the previous expansion. The Federal Reserve is concerned about inflation. As I mentioned, they're reducing their purchases of securities. They're also going to increase short-term interest rates in 2022. The federal funds rate, that's their key short-term interest rate. That's been basically at zero since the pandemic hit in early 2020. I would expect that we will see 3 increases in the federal funds rate in 2022, which would take it up to around 1% by the end of this year. So I do expect, we've already seen long-term interest rates increase, as I mentioned. I would expect that short-term interest rates will also increase this year. And by raising interest rates, the Federal Reserve is hoping to slow economic growth in order to reduce some of those inflationary pressures that we are seeing in the economy. And other inflationary pressures will recede as businesses figure out their supply chains, as they come up with workarounds, as they increase production, as some of those people who have dropped out of the labor force come back in and reduce some of those labor pressures that we're seeing. I think it's still going to be a tight labor market, but it's not going to be quite as tight as what we are seeing right now. But I expect that inflation will slow over the course of 2022, 2023, and that by the end of next year, inflation will be around the 2% inflation objective that the Federal Reserve is looking for. Sorry, and I just realized, of course, that with the new year, that I forgot to update that. That should say January 2022 forecast, not January 2021 forecast. I'm sorry. No. Okay. Let's back up. All right. This is our forecast for economic growth in the U.S. economy. So the orange line is our forecast from roughly a year ago. And you can see that we did see a big rebound in the economy as the economy reopened, and we did have strong, solid economic growth in 2021. We expect that our forecast now is stronger than it was last year at this time. That we think that the U.S. economy will continue to expand at a strong pace, did expand at a strong pace throughout 2021, will expand at a strong pace throughout 2022 into 2023, thanks to vaccination efforts, thanks to additional federal government stimulus, all of that. We got more stimulus in 2021 that we were expecting a year or so ago. We got the American Rescue Plan that was passed. We got vaccination rollouts in spite of everything. We've got a lot of people vaccinated. So even with the Omicron variant and all of that, I still think that the economy will continue to expand at a strong pace throughout 2022 into 2023. And similarly, the labor market will continue to improve. The unemployment rate, which was 3.5% below before the pandemic, jumped up to 15% in April of 2020, was down to 3.9% as of December of 2021. So that's just above the 3.5% unemployment rate that we had before the pandemic. And I expect that by the end of this year, the unemployment rate will be back around to that 3.5% unemployment rate that we saw before before the pandemic. So continued improvement in the labor market over the next couple of years, even as more people come back into the labor force as the pandemic recedes. But that being said, it is going to be an uneven recovery. So I set the peak for all of these measures from before the pandemic equal to 100. Real GDP, as I mentioned, that's actually slightly above its pre-pandemic level. Business fixed investment, I think, is going to lead the economic recovery over the next couple of years. Businesses will invest to make their workers more productive, to fix their supply chain difficulties, and so forth. Employment is going to be slower to recover. I think we'll see a new employment peak sometime in the middle of this year. Employment is typically slower to recover than the overall economy. Industrial production, output of manufacturers, mines, and utilities. I would, again, that will be a little bit slower to recover than the overall economy. On the other hand, the housing market, as I mentioned, has been a big contributor to recovery. Housing starts, a red line there. I think we'll see a little bit stronger housing activity in 2022 as some of these supply chain difficulties are worked out and as builders put up more homes. And then we'll start to see housing starts fall in 2023 due to the impact of higher mortgage rates. But definitely a solid recovery over the next year and throughout 2023 as well. That being said, there's still a lot of uncertainty out there. So here's what I'm pretty sure about. That we did experience a very steep recession in 2020, but that we will have continued recovery this year and into next year. That inflation will slow this year, but we are seeing structural shifts in the economy. We're seeing, even before the pandemic, we were seeing movement away from traditional retailing towards online sales. That process intensified with the pandemic. That's not going away. We're seeing businesses rethink their supply chains. So they're holding more, they're going to hold more inventory in the future than they did before the pandemic. They may source more from the United States or from Canada and Mexico because they're seeing the problems that they're getting inputs from overseas. And then we're going to see shifts in commercial real estate markets. You're going to see less demand for office space as more people work from home and they place a greater value on workplace flexibility. On the other hand, we're seeing more demand for industrial warehousing space because of increasing purchases of goods that we bought online, increasing shipments and so forth. So big shifts in commercial real estate markets. What I'm less sure about is, key thing is what happens to the pandemic. Until the pandemic is more like the seasonal flu, it is going to weigh on the economic recovery. And in particular, it's going to weigh on consumer spending on services. The forecast that I showed you, this includes the bipartisan infrastructure bill, but it does not include the second piece of the Biden administration's proposals, the Build Back Better program, which includes some social spending. I think that could add to economic growth in the near term. On the other hand, it could raise borrowing costs, could cause the Federal Reserve to raise interest rates more quickly. So we'll have to see what happens there. But that is not, the Build Back Better bill is not included in the forecast that I showed you. What's the impact of the pandemic on longer run growth? Is it going to cause long run damage to the economy? I'm hopeful that it won't, but it still has the potential. And then finally, the housing market. Many of us are moving out of cities into the suburbs or the more rural areas, moving out of apartments in single family homes into, moving out of apartments into single family homes. And I think this is very important for an area like the Twin Cities where, I mean, let's be honest, the weather in the Twin Cities is not the best. And if people have more workplace flexibility, what does that mean for people who have office jobs in the Twin Cities? If they can work in a warmer climate, if they don't need to be in the office, then that could be a problem for the Twin Cities population growth economy over the longer run. So that's something that is a concern, but we'll have to see how that plays out. Let's talk a little bit about regional economic conditions. So this is the Philadelphia Fed's Coincident Index. This is conditions as of February of 2020. So right before the pandemic, and as I mentioned, conditions were generally solid. Most states were seeing economic growth in early 2020 before the pandemic. Certainly no indication of bad news out there. Then you go forward to May 2020. This is at the worst. and you can see that every state is in that dark red, deep economic contraction category. And that's different from most recessions in the United States, where usually there are one or two pockets that are doing okay. Not the case this time around, very severe contraction. And then we go forward to the latest coincident index from the Fed. This is as of November of 2021. And you can see that most states were in economic expansion. Michigan, because of the auto industry problems, was in a downturn, but most states, including Minnesota, were seeing expansion in the United States at the end of 2020, even with the Delta variant that was then prevalent. Let's look, shoot, and I'm sorry, this is my fault. Let's see if I can find those charts. Give me a second here. This, I feel bad. I was gonna do that. I'm supposed to, give me 1 second. All right.
Well, folks, while Gus is getting that slide up, I'll let you know at the end of the presentation, the CPE credits will be available. 7 to 10 business days is typically the amount of time it takes. Several questions have come through. And we'll get to your questions in just a few minutes. Thank you.
And Nancy, do you want to put up that last question too?
Absolutely, the last question.
While I try to get this up.
Sure.
Sorry.
That's no problem.
And I feel bad about this. I have specific slides for the Twin Cities that I want to make sure that I get up here.
Okay, folks, I'm going to end that last poll, and I'm not sharing those results because it seems all of you really enjoyed the session.
All right. Oh, good. All right. Hold on for a second. We're in good shape here.
Okay.
And I think I have those slides here. Let me see. Okay, so I got to run through these, but we're good. There we go. Okay, let's talk a little bit about, there we go. That's what I wanted. Okay, so you can see, I said that the peak in employment before the pandemic equal to 100 for the US, for the Minneapolis, St. Paul, Bloomington metro area, and then for Minnesota. And you can see that the recovery in the Twin Cities has been slower than the recovery that we've seen nationally. So nationally, employment is down by about 3 or 4% from before the pandemic.
Yeah. Sorry to interrupt, but we are looking at the Pittsburgh area slides.
Oh, okay. Hold on.
Yeah, which is a little confusing for them.
That's fair enough.
Mm-hmm.
All right. Stop share. All right. Give me 1 second here. I do have the correct ones.
That's
share.
Okay.
There we go. I think.
That's good.
All right, there we go. Sorry about that, folks. Okay. So you can see that the recovery is incomplete in Minnesota and the Twin Cities relative to the rest of the country, that employment is still down by about 5%. So it's been a slower recovery in the Twin Cities area relative to other parts of the country. And part of that is that, you know, the health services industry is very important for the state and for the area. You know, that's been slower to recover in part because of some burnout in the industry. And some of the business professional services jobs in the Twin Cities have been slower to come back than what we're seeing nationally. We've had a big house price cycle nationally. You can see that house prices are up about 20% year over year nationally as of the end of 2021. Still strong house price growth in Minnesota and the Twin Cities, but not quite as strong. And I think, you know, that supports housing affordability, supports household wealth in the Twin Cities. So that does bode well for continued expansion in the Twin Cities economy in 2022, 2023. And then finally, this is the most important thing I'm going to show you all day, which is that you can see the population growth. Let's not worry about 2020 for now, because I think that's been skewed by the pandemic and the census. But generally, population growth in the Twin Cities has been well above the national average. And workers in the Twin Cities tend to be highly skilled, highly educated, highly compensated. And that attracts businesses that are looking for these types of workers. So that bodes very well for long-run economic growth in the Twin Cities. Now, as I mentioned, the concern about work from home, climate, all of that kind of stuff, that could be a big problem for the Twin Cities area going forward. But generally, this above average population growth does bode very well for long-run economic growth in the Twin Cities area. I would encourage you to find all of our materials at pnc.com/economic reports. You can follow me on Twitter at Gus Faucher PNC. Thank you very much for your time, and let's take a few questions if people have questions. So I believe that we have a chat function. So if you just want to answer your questions into the chat function. We already have some questions there. Okay, so let me take a look and go through these. All right, U.S. national debt, we talked about that. Is the true inflation rate higher than the published rate? I don't think so. I think the Bureau of Labor Statistics does a good job of trying to track the goods and services that consumers buy. It adjusts for quality differences, the fact that cars now are better than they were 15, 20 years ago, that type of thing. So I think overall, the measure of inflation that we're looking at, I think that is reasonable. Do I believe that the Build Back Better bill will bring down inflation? I am skeptical that Build Back Better will bring down inflation. I also don't think it would add much to inflation over the long run, but I don't think it would actually reduce inflation over the long run either. Okay. Good question about whether COVID coming back in China could cause further supply chain issues. That is certainly a downside risk to the outlook. We're still getting a lot of goods from China, even with companies trying to diversify their supply chains. China has been very vigilant about COVID, and if we see big chunks of the Chinese economy shut down again, that could cause further supply chain issues and could add to inflationary pressures. Let's think. Expiration of PPP loans generate future bankruptcies. Certainly that potential is out there. Many businesses remain stretched. That being said, business bankruptcies were surprisingly low during the pandemic. They're low now. And we are seeing strong demand. We are seeing businesses generally able to raise prices to keep up with higher input costs. So there is some potential for higher business bankruptcies out there. As I pointed out, the debt service cost is low. So something we're watching, but I don't think that represents a big threat to the economic expansion. Okay. Future interest rate increases on consumer debt. Okay. Let me go back up and show that chart. Remember, debt burdens right now as a share of after-tax income are extremely low. And so, where's that chart? There it is. So even with somewhat higher interest rates, I don't think that consumer debt represents a threat to the current recovery that is underway. And I also think that although interest rates are going to be going up, they're not going to go back to where they were before the Great Recession, certainly not in the 80s and 90s, where we had the 30-year fixed mortgage rate at 7 or 8%, something like that. Maybe it gets up to 4%, 4.5%. And so I don't think that interest rates on consumer debt, on business debt are going to increase enough that they would pose a threat to the current recovery that is underway. Do we think that government bailouts were excessive? I would say that I would much rather have had too much aid from the federal government than too little. And so maybe they were excessive. We'll have a better sense of that in a few years. But I think that given the state that the economy was in, given those enormous job losses, given the low borrowing costs for the federal government, I think we are much better off with a lot more, with too much aid rather than too little aid. So in terms of the increases in the Fed funds rate, I would expect that there would be 3 this year, maybe 3 next year, each of 1/4 percentage point. So the Fed funds rate, which is now between 0 and 1/4, ends this year somewhere around 0.75, 1%, and then it ends 2023 at somewhere around 1 3/4%, 2%, something like that. Question, what keeps me up at night? The big thing that keeps me up at night is the pandemic. Again, until we get the pandemic under control, we are not going to have a strong economic recovery. And then the other thing is, I presented I do think that inflation is going to slow. But if I'm wrong, if inflation stays higher for longer than I'm expecting, then the Federal Reserve is going to have to act more aggressively. It's going to have to raise interest rates more quickly. And that could be a significant drag on the economy and could even push the economy into recession. That's oftentimes how recession starts, from the Federal Reserve over tightening. So that is a concern out there. All right, I think we're getting to the top of the hour, so I'm going to stop here. But thank you all very much for your time. I appreciate the opportunity to speak with you this morning. I appreciate you working through me with the technical difficulties. But it's been a pleasure talking with you this morning, and thank you very much for your time. I appreciate it.
Thank you, Gus. This was an excellent presentation. Folks, the recording will be available shortly, as well as the presentation. CPE credits, again, between 7 and 10 business days. If you have any further questions, you can put them in the chat and we'll get them out to you. We do appreciate your attention, and this does end the webinar. Have a great day. Thank you, Gus.